All right, everybody, welcome. Merrill Chandler here. We are at the Fundability Report. So in this episode of the Fundability Report, we got three things we kind of want to take a look at. The first is really the top 5 banking trends for 2023. And interestingly enough, these banking trends kind of follow suit with what we've been closing down 2022 on. But I wanted to share that there is a let me make sure I have my there we go. So one of the things that is really interesting is 2023 is focusing on about customer experience. Now, for 2 years now, we've been talking about banks have been reasserting themselves where it's relationship over transactions. Well, what we're finding is that these relationship building skills are growing when it comes to a significant rise in online access to opening checking accounts. We've been able to do credit cards, even business credit cards over online, et cetera, even over the phone. If we call up Chase or American Express, they'll fill out an application over the phone. Here, checking accounts have a different type of relationship because since it's real cash instead of credit, there are a lot of hoops to jump through. Well, one of this, because of fraud, money laundering purposes, et cetera, the Patriot Act, a bunch of things. So one of the things that we're going to be facing in 2023 is zeroing in on customer priorities. Almost think of it as cafeteria banking, where here's our offering, and let's build you a package. And sometimes so it's not one size fits all, but if you want a checking and a savings and a retirement account, they'll bundle that. If you want a credit card, credit line, and business loan, they'll bundle that. Mm-hmm. Checking account and cash flow accounts can be mixed and matched. And there are 2 tier 1s and several tier 2s that are looking at this cafeteria style banking. They want to match your value sets, right? If it's cash flow based or retirement based, as I said, if it's credit product based, even mortgages bundling, and I don't know where they're coming up with this. We know that FICO loves borrowers who have at least one mortgage, home loan, and at least one auto loan, but they're starting to bundle like insurance does. You say, hey, if you have homeowners insurance and you have auto insurance, we give you a discount. So they're discounting different products as you bundle them. So let's be on the lookout for that. I think that is amazing, and it allows our fundability practices, right? The things that we're doing to become more fundable. It's actually creating an opportunity, maybe even to get one credit pull for multiple credit products, because we're able to batch them. So more on that later, but I think we're in for a good a good thing there. Customer demand is driving strategy, right? Economic recovery is still uncertain, and so the 54% of financial institutions that were surveyed said that that a recovery from a recession will not be until 2024. So that's at least 12 to 18 months from now. Right? 9% believe that we've already recovered. So there are going to be, economic concerns are still important. Financial institutions plan for tech spending that 56% of the organizations, the financial institutions that were surveyed, literally 56% are putting a significant, that's not a highly quantitative number, but a high investment in technology. Technology means more automatic underwriting, more database use of databases out there to evaluate your fundability, et cetera. So technology spending will increase. Crypto transactions will stay on the horizon, but bringing on digital currencies is going to be big this year. And mergers and acquisitions have kind of slowed down, and they think that mergers and acquisitions will still kind of slow down or keep its current slow pace through 2023. Prospects for 2023 are amazing for us. Fundability. Remember, it does not matter the lender. Everybody has underwriting criteria, and the principles of fundability apply to manual or automatic underwriting. And so all the effort you invest, everything that you're doing to create clarity and become more fundable will create higher yields over time with every type of lender on the horizon, including those cryptocurrencies that are backed by cryptocurrencies or otherwise. Next thing that's to be looking for is that 2022 saw a steep decline in the cost of overdraft fees, and many banks even got rid of them completely. The Citigroup and Capital One were big players in getting rid of them completely. Wells Fargo has reduced significantly and is actually adding to small dollar loans so that they can customers can mitigate or get rid of these transactions of these using loans instead of credit lines as they have in the past. And we know that we don't want credit line accounts to be a part of our overdraft fees. Wells Fargo is actually using instead of doing an overdraft, that they're using like a buy now pay later strategies, right? Where if you do get an overdraft of a certain amount, let's say it's like $200 overdraft, it's going in as a loan rather than a credit line, and that dollar value loan. We don't know the reporting features, but we do know if it's reported as an installment loan, it has less damage than it will do than having a credit line tapped for an overdraft fee. So there's a lot of powerful things going on there. And so these small dollar loans could end up being a boon to the unbanked, so that they feel more protected and not charged overdraft fees. That's one of the big things that we're moving into in 23 and 24. Get Fundable is all about addressing the unbanked, right? The unfundable, the folks who are even terrified of getting checking accounts and not building traditional banking relationships. We're helping to mitigate that through our training programs, training platforms, et cetera. So, and then finally, we want to for 2023, there is becoming a more value is being placed on the relationship than transactions. Yes, I've said that the relationship piece a number of times over the course of the last year, but transactions in an account has been one of the main features of how important is this person, this depositor, this borrower. How important are they to us? And so they're looking for the relationship, like longevity. For example, in mortgages, refinances are transactions, right? But so what they're looking for is they're measuring how often do you refinance, but not necessarily how long you have been with them holding a particular mortgage. So that's one of the ways in which they're changing the metrics, their KPIs, key performance indicators. They're changing some of those to, if not get rid of, at least include more that talk about longevity of relationship and total dollar volume. We know that the 1247 model is a relationship building model, right? How valuable are they to us? Now it's not just what the current rate is, but our current balances you might have in your checking account, but how long you've had them. We already optimize for those in our fundability trainings. And all the software that we're developing rewards us for having these relationships over the long haul. So we are All set. So that is today's fundability report. And for those of you who are listening, and you're a member of the Funding Hackers Facebook group, we're heading over there to do our Q&As and help each one of us navigate the holidays with and remaining highly fundable during moving into 2023. You guys have a brilliant day, and we'll be back on Thursday for Funding Hackers, but I won't see you until next week after Christmas. We're in the middle of Hanukkah, and for those of you, Kwanzaa's starting up next week. So you guys have a fantastic